Let me start with a number that shows up in almost every multifamily investment pitch you'll ever see: 16%. If you've ever looked at a syndication deal, reviewed an investor deck, or spoken with a sponsor, you've probably seen that number, a 16% IRR. It's become the industry standard target. But here's the uncomfortable question almost no one ever asks. What actually has to go right for that 16% IRR to happen? Because behind that number is a stack of assumptions. You've got rent growth assumptions, exit cap assumptions, refinance assumptions, and timing assumptions. And if any of those assumptions are wrong, that 16% IRR can collapse very quickly. Now, here's the interesting part. Over the last year alone, our team at LFS Capital acquired over 1,300 multifamily units, representing more than $200 million in transactions. And during that process, we reviewed hundreds of deals. What we saw over and over again was something most passive investors never notice. Many sponsors are trying to engineer a 16% IRR on paper instead of building a deal structure that can survive reality. And those are two very different things. So in this video, I want to break down how a 16% IRR is actually created, where most sponsors go wrong trying to hit that number, and how we structure deals differently so the return isn't dependent on perfect conditions. Because once you understand this, you'll never look at an investor deck the same way again. If we haven't met before, I'm Adam Williams. I'm the founder of LFS Capital, and for the past 2 decades, I've focused almost exclusively on multifamily real estate. And over the years, I've reviewed thousands and thousands of deals, both good and bad. And what I've learned is this: the number of sponsor advertised is often the least important part of the investment. The real question is how that number is created, because the structure behind the return tells you far more about the risk than the return itself. And nowhere is that more obvious than with a famous 16% IRR target. Now let's talk about why 16% IRR became the industry benchmark in the first place for most multifamily deals. See, investors expect something like a 6 to 8% annual cash flow, plus appreciation over time, plus equity creation through the renovation. And when you combine those factors over a 5-year hold, you often land somewhere around 15 to 17% IRR. So 16% naturally became the magic number. But here's the issue. In many investor decks, that number isn't the result of conservative assumptions. It's the result of reverse engineering. The sponsor starts with the goal: we need to get this deal to show a 16% IRR. And then they adjusted the variables until the model hit that target. Maybe rent growth becomes 4% instead of 2%. Maybe the exit cap rate tightens instead of expanding. Maybe the refinance happens earlier, and maybe the sale price assumes a more aggressive market. And none of those changes look dramatic individually, but when they stack together, they can dramatically change the outcome of a deal. And the investor never sees how fragile the assumptions actually are. So let's walk through an example, because once you see the math behind the IRR, you'll start understanding exactly where the deal can break. Let's imagine a very typical multifamily deal. A sponsor purchases a property for $20 million. They raise $6 million of investor equity. They plan to renovate the units, increase rents, and sell the property in 5 years. The investor deck shows something like this: 7% annual cash flow, a sale in year 5, and a total projected IRR of 16%. It looks attractive, right? But let's unpack where that IRR actually comes from. If investors receive 7% cash flow annually over the 5 years, they earn about a 35% cumulative cash yield. So where does the rest of the return come from? Well, it comes from the sale, which means a huge portion of that IRR depends on the exit price. And let's say the property sells for $28 million after 5 years. That creates the projected equity multiple needed to hit roughly a 16% IRR. But now let's adjust just one variable. Instead of selling for $28 million, the market softens slightly, and the property sells for $25 million. That's not a catastrophic difference. It's actually a pretty normal market shift. But watch what happens. The investor IRR might drop from around 16% to around 11%. Now let's adjust a second variable. Let's say the rent growth was projected at 4% annually, but the real number ends up closer to 2%. Now the exit value compresses again. Suddenly that projected 16% IRR might be closer to 9 or 10%. And that's the part many investors never see up front. The difference between a great deal and an average deal can come down to just a few optimistic assumptions in the deck. Now, this doesn't mean IRR is useless. It actually is a helpful metric, but it's not a strategy. It's just the output of the model that's put in front of you. And if the model is fragile, the IRR is naturally going to be fragile too. Now, here's where the conversation gets more interesting, because sophisticated sponsors do not start with the IRR. They start with structure. Instead of asking, how do we get this deal to show a 16% IRR. The better question is, how do we build a deal that can survive imperfect conditions? Because markets are never perfect. Interest rates move, rent growth slows, cap rates expand, and unexpected repairs happen. The deals that perform well over time are the ones that were designed to handle uncertainty. And that's where what I call layered income becomes important. A strong multifamily investment typically has 3 return engines. Engine number 1, cash flow, consistent income from operations. Engine number 2, forced appreciation. That means increasing the value through renovations and operational improvements. And engine number 3, market appreciation. That's long-term growth in property values. The mistake that most sponsors make is relying too heavily on engine number 3. In other words, the deal works only if the market cooperates. But when a deal is structured correctly, cash flow and operational improvements do most of the work for you. Market appreciation becomes the bonus, not the requirement. And that difference dramatically changes the risk profile, which brings us to a framework I use when evaluating every deal we do. I call it the passive framework. It's the lens we use to determine whether a deal is durable enough to pursue. Let's walk through it together. P stands for predictability. How stable is the income? Multifamily works well here because people always need housing, but predictability also depends on a tenant base, location, and operating expenses. A stands for alignment. Are the sponsors and the investors aligned? Do the sponsors have meaningful capital in this deal? Is the compensation structure fair? Alignment reduces the risk for poor decision making. S stands for safety margin. The first S stands for safety margin, and this is critical. What assumptions does the deal require to succeed? If the deal only works under perfect conditions, there's no margin for safety. The second S stands for scalability. Can the strategy work across multiple properties? See, institutional investors care about repeatable systems, not one-off wins. Now, I stands for inflation resilience. See, real estate has historically performed well during inflation because rents can adjust over time, but that depends on supply constraints and local demand. V stands for volatility exposure. How sensitive is the deal to interest rates, cap rates, and market cycles? You see, lower volatility exposure means fewer surprises. And last but not least, E stands for exit clarity. How many exit options exist? Can the property be refinanced, sold to another operator, or held for long-term income? The more exit paths available, the safer the investment tends to be. And when a deal checks those boxes, the IRR usually takes care of itself, which is exactly how we approach it. This is one of the reasons I've spent the last 2 decades focused on multifamily. Not because it's trendy, not because it produces flashy numbers, but because it's structurally durable. You see, housing demand is persistent. The income is diversified across many tenants, and operational improvements can create value independent of market timing. That combination creates something powerful, predictable income with long-term appreciation. And when those two forces work together over decades, that's how real wealth is built. Not through speculation, but through disciplined structure. At the end of the day, every investor eventually faces a decision. You can be a hope-based investor, that's someone who relies on market conditions, projections, and optimistic models. Or you can become an income engineering investor. That's someone who focuses on structure, durability, and predictable cash flow. You see, the difference between those two approaches may not show up in the first year, but over 10, 20, 30 years, it can completely change the outcome. If you're interested in learning how we structure multifamily investments and evaluate whether this strategy fits your long-term goals, you can visit elevescapital.com and book a call with our team. During that conversation, we'll look at 3 things: your current portfolio, your long-term income goals, and whether multifamily investments could play a role in that strategy for you. My mission is to help people like you create real wealth and passive income through investing in multifamily real estate. It's how I built my family's fortune over the last 2 decades, and in my opinion, it's one of the most trusted ways to build lasting wealth. In the next video, I want to show you something even more important. We're going to break down how to evaluate a multifamily deal like an institutional investor, so you can quickly spot the difference between a strong opportunity and a projection that only works on paper. Because once you understand that skill, you'll start seeing deals very differently. I'll see you on the next video.